Hey all, how you doing? I wanted to throw together another video here just on a couple of exercises. It's exercise E10.2 and then I'm going to do E10.3. I'm going to walk through them real quick because you can pause and rewind and watch them again if it's too fast for you. A lot of it's pretty straightforward. Some of it's beyond what I would expect on an exam, so I just want to kind of highlight that and then kind of a review of what costs get included in PP&E. So this question, we have a bunch of expenditures on a piece of machinery is part A, and they're saying what are we going to capitalize as the cost of machinery. Okay, so cash paid is $112,000. There's $100,000 for the machinery, $7,000 sales tax, so that's a provincial sales tax, and $5,000 a GST. Oops. What gets capitalized is 107. So we don't have sales tax in Alberta, so not too many are used to it, but sales tax is something a company pays and on equipment doesn't get back. GST is not an expense to a company, they get it back. So any GST a company pays, they get back, so that would not be included. But the PST, provincial sales tax, is. Freight and insurance costs on transit, well, those are fine. That's just a normal cost of getting it where I want it, in the condition I want it. Cost of moving machinery into place, again, where I want it, condition I want it. Testing wages and testing materials, those are both fine. You need to get it working. So this is before it's working. Insurance premium paid on the machinery for its first year of operations. No, that's an expense. You can't charge expenses related to the first year of operation. Plumbing fixtures, that's pretty straightforward. I need to plumb it in. The first year repairs again though, that's an expense. We're not going to include that. And in the government grant, although they don't give us an accounting policy here, I don't believe, the assumption in question is you're using cost reduction. Cost reduction is quite a common one, so it's going to come out. So what they are going to charge to their machinery account is $99,600. Okay, so the key things, everything to get it where you want it in the condition you want it. Provincial sales tax is part of the cost of the asset, GST is not, and any expenses during the year you can't include in the asset, and the government grants typically going to come out. Self-construction equipment, so part B of this. We've got material purchase. I am not going to test you on this. I find it kind of goofy. I don't know why the textbook highlights this. They didn't, I don't believe, in the 11th edition. But what we're saying is we got machinery that cost $200,000. There was a 2% discount available. We didn't take it. Typically, we use the net method. So what they're saying is I should record the untaken discount as a finance expense. Again, I am not going to test you on that, so don't worry about it, but just to get the answer to the question, and I think on the assignment we have that same issue. Imputed interest, again, this is beyond what I'm going to test you on. And for our purposes, I do want you to be able to deal with interest, but any question you will see, it will be actual interest and it'll be calculated and you'll have the amount. So, you might see one where we incurred $5,000 of interest during construction and then know how to deal with that. Don't worry about imputed interest. Labor costs for manufacturing equipment, that's fine. I broke down, they've got overhead here, fixed 20 and variable 20. You can't include fixed. Okay? Any fixed overhead I mean, that's an allocation of expenses that were going to occur anyway, so you don't include them. But variable overhead, you can. The logic being those are costs you incurred because you constructed this asset. Profit on self-construction, that should be kind of obvious. You can't include profit you make on something you're building for yourself. And installing. So the self-constructed equipment is going to come in at $420, $400. Okay. So key things there, don't worry about imputed interest. Just know how to deal with actual interest and you'll get the amounts. Fixed overhead on something you manufacture yourself does not get included. 10.3, same kind of idea. I just wanted to spend a little time on one, but quick review. We want journal entries. The first one's a grant, right? The City of Pavement gives the companies 5 hectares for land. So we do need to record the land at its fair value. And we can't really use cost recovery because we didn't get cash or anything. So we do need to record as either grant revenue or deferred grant revenue, and we're not going to get into the difference between those two. Key thing is you got to record the land. Part 2, we issued some common shares in exchange for land and building. They go through and give us all the values for the land and building. And then they talk about the shares and how they're private, and there was some issued, whenever. Again, you want to pick the better estimate. The shares of a private company are not a good estimate, so we're going to use the fair values that were appraised for the land, the building, the HVAC, and the interior. Again, we have to componentize the land and building into their parts that are different, which is what they've done here. And again, if this was a public company and they issued shares, we would use the share value and we allocate the fair value to that. Number 3, again, we've got a list. What we're saying is we built something and we haven't recorded it yet. So what we want to do is create this machinery we built, and we just have to figure out what do we want to include. So we pulled some stuff out of our inventory. So I do need to record that as a reduction in inventory and into my asset. I use some materials. I mean, the wording's a little goofy here. Some of it's out of opening and some of it's out of other. I wouldn't get too hung up on it. Supplies. Well, supplies, if we used them, we do want to get them out of our supplies inventory. Direct labor incurred. So right now it's sitting as labor expense. I want to get out of there and record it as part of my machinery. Additional variable overhead over regular cost by construction machinery. So, and charge to inventory. So this 8,700 is variable overhead, and that I want to get out of my inventory because it told me it's in inventory now. Fixed overhead rate applied to regular manufacturing. So again, fixed overhead doesn't get included. Lost revenue due to downtime. Lost revenue doesn't get included. And the cost of similar machinery for them purchased from outside suppliers. That's giving you an indication of fair value, but again, that's not a number that we would use to account for this. We don't need a fair value. We've got actual values. So there's my inventory amount. So my machinery is going to go in at the total of those 3. Okay. So, again, just fixed overhead, variable overhead was a key thing here, and get all the other costs related to something you build yourself into that asset. Thanks all.